The world of oil trading just got a little more intriguing, and here's why it matters to everyone watching energy markets. Oil prices surged by over $1 on Monday, clawing back some of the ground lost last week. This rebound followed OPEC Plus's announcement of a production increase that was notably smaller than many experts had expected. But here's where it gets controversial. While OPEC Plus signals a boost in output starting in October, the move is modest enough to stir debate, especially with looming geopolitical uncertainties, including potential fresh sanctions on Russian oil. To set the scene, OPEC Plus refers to the coalition of OPEC countries plus Russia and several allied producers. This group coordinates oil production to influence prices globally. This week, they agreed to raise production by 137,000 barrels per day, BPD, beginning October, much less than the hefty jump seen in previous months, such as the 555,000 BPD increase in September and August, or the 411,000 BPD boosts earlier in the year. So why such a cautious approach now? Analysts believe part of this output rise merely legitimizes barrels already flowing into the market, as some members have been producing above agreed targets. Ole Hansen, a seasoned commodity strategist at Saxo Bank, explained it like this. The market had run ahead of itself, expecting a larger OPEC Plus increase. What we're witnessing is a classic sell the rumor, buy the fact phenomenon, where traders initially anticipated more supply, selling off oil beforehand, only to snap back when reality proved otherwise. By around 8:58 GMT, Brent crude was up by $1.16, or roughly 1.8%, to $66.66 per barrel, while U.S. West Texas Intermediate crude climbed $1.09, also a 1.8% gain, reaching $62.96 per barrel. Both benchmarks had tumbled Friday by over 2%, weighed down by a disappointing U.S. jobs report, which dampened expectations for near-term energy demand. The weekly drop topped 3%, reflecting uncertainties in global economic growth and energy consumption. This modest production uptick from OPEC Plus comes despite anticipation of an oil surplus, or glut, in the Northern Hemisphere's winter months, when demand typically weakens. This cautious stance suggests the group is trying to balance out market risks, avoiding oversupply that would drive prices lower. But the plot thickens when considering geopolitical tensions. The prospect of new sanctions aimed at Russian oil exports adds a layer of complexity. Toshitaka Tazawa, an analyst at Fujitomi Securities, points out that market expectations of tighter supply from these possible sanctions are supporting prices. This week, former U.S. President Donald Trump hinted at escalating sanctions on Russia, referring to a second phase of measures targeting Moscow and entities buying Russian crude, closely connected to the ongoing Russia-Ukraine war. These sanctions could disrupt existing crude supply chains, as noted by Frederick Lasser of energy trader Gunvor, potentially tightening the market further. Meanwhile, the war in Ukraine itself hit a grim milestone, as Russia reportedly launched its largest air attack since the conflict began, targeting central Kyiv and setting the main government building ablaze, an attack that tragically claimed at least 4 lives. This development keeps the conflict and its ripple effects on energy markets front and center. In a related development, Trump announced that European leaders plan to visit the United States shortly to discuss paths toward resolving the Russia-Ukraine conflict. This diplomatic activity underscores how intertwined geopolitical events are with global energy dynamics. Looking ahead, investment bank Goldman Sachs has provided a tempered outlook, predicting a slightly larger oil surplus in 2026. Their analysis highlights how increased oil supplies from the Americas are expected to offset declines from Russia and are balanced against stronger global demand. Despite these shifts, their forecast for Brent and WTI crude prices remains steady for 2025, with projected averages of $56 and $52 per barrel in 2026, respectively. So what does all this mean for you? Whether you're an investor, a policymaker, or simply a consumer paying attention at the pump, the delicate dance between OPEC Plus production decisions, geopolitical tensions, and market expectations continues to shape global energy prices in profound ways. And this is the part most people miss. The nuanced decisions by OPEC Plus, combined with shifting geopolitical landscapes, can trigger ripple effects that influence everything from oil prices to economic stability worldwide. What's your take on OPEC Plus's cautious approach? Is this a savvy move to stabilize markets? Or are we witnessing a temporary band-aid in an increasingly volatile energy landscape? And how much faith should we really put in forecasted supply balances given the uncertainty around sanctions and the ongoing conflict? Share your thoughts and join the conversation.